Welcome to the deep dive. We're really thrilled to have you with us today.
Yeah, thanks for joining us. I'm excited for this one.
Because if you've opened a newspaper or scrolled a news feed or even just eavesdropped at a coffee shop recently, you know that absolutely everyone is talking about the AI boom.
Oh, everywhere. It's all you hear about.
Right. We hear about the explosive growth of cloud computing, massive new language models, just this whole overarching digital revolution.
Yeah.
But today, we're taking a slightly different approach. We are looking past the flashy software headlines and the Silicon Valley keynotes to focus on the literal nuts, bolts, concrete, and fiber optics, making it all possible.
It's so easy to view the internet and AI as these invisible weightless things that just exist in the ether.
Like magic.
Exactly like magic. But the physical reality of our digital world is incredibly heavy. It's incredibly complex, and it requires just a monumental amount of raw physical labor to maintain and expand.
And to explore that physical reality, we've got a really fascinating stack of sources for you today.
We do.
We're looking at the freshly released Q4 2025 earnings report and the conference call transcript from February 26th and 27th, 2026. This is for a company called MasTec.
Right. And if you haven't heard of them, they are a massive North American infrastructure engineering and construction company.
Our mission for this deep dive is to decode what their staggering $19 billion backlog tells us about the future of America's power grids, data centers, and pipelines.
Yeah, that backlog number is it's huge.
It is. Okay, let's unpack this because I was looking at this Q4 earnings report and the scale of the financial beat completely caught me off guard. They didn't just meet Wall Street's expectations, they blew past them in a way that feels almost historical.
They really did. To put it in perspective, we're looking at nearly $4 billion in revenue for just the fourth quarter alone.
$4 billion
Right.
in one quarter.
One quarter. That's a 16% increase from the previous year, beating expectations by over $225 million. And when you zoom out to the full year of 2025, their revenue hit a record $14.3 billion.
And the profitability metrics completely followed suit. I saw their earnings per share came in at $2.07, completely crushing the consensus estimate of $1.94.
Yeah, it's a huge beat.
Plus, their outlook for 2026 is projecting $17 billion in revenue and $1.45 billion in adjusted EBITDA. But tell me if I'm reading this wrong. The real story here, the metric that actually tells us where the broader economy is heading over the next few years, isn't the revenue they've already booked. It's the backlog, right?
What's fascinating here is that you've hit on the exact metric that dictates the future of physical infrastructure. When a heavy construction company like MasTec reports their financials, the backlog is essentially their waiting list of contracted work. It's the roadmap of what's about to be built across the continent. MasTec's official 18-month backlog grew by a staggering 33% year over year to $19 billion.
$19 billion of work just sitting there waiting to be executed over the next year and a half.
Exactly.
What does that actually look like in the real world? I mean, are we talking about thousands of trucks just lined up waiting for the word go?
It looks like supply chains stretched to their absolute limits. It looks like massive staging yards filled with spools of high-voltage cable, specialized excavation equipment, and fleets of bucket trucks. But the details from the earnings call reveal a layer to this that is even more incredible. The shadow backlog.
A shadow backlog. That sounds like some kind of covert operation.
Right, it does. But it's essentially work that is virtually guaranteed but can't officially be put on the books quite yet. During the call, management highlighted that in their renewable segment alone, they have over $4 billion in projects under contract that extend well beyond that immediate 18-month window.
Wow.
It also includes work that's currently under what they call a limited notice to proceed.
Limited notice to proceed, meaning have the contract, they might even have the equipment ready, but they're just waiting on a local county commissioner to stamp a permit or finish an environmental review.
Precisely that. The site is selected, the financing is there, but the physical dirt cannot be moved yet. So there's an extra $4 billion of massive demand that isn't even counted in that official $19 billion figure.
For you listening, if you ever find yourself wondering whether the tech and infrastructure boom is starting to slow down, A $19 to $23+ billion waiting list for physical construction projects gives you a very clear, very loud answer.
Absolutely.
The physical build-out is not slowing down. It is accelerating. And that leads perfectly into one of the most surprising reveals in these sources. MasTec booked nearly $1 billion in data center-related work in the fourth quarter alone.
Yeah, that number is staggering.
$1 billion just in Q4 just for data centers. We have to look closely at the strategic shift embedded in that billion-dollar figure because it represents a major evolution in how they do business. This wasn't just standard piecemeal contract work where they show up to dig a trench and leave.
Right.
This figure includes MasTec's very first turnkey construction management agreement for a massive data center.
Turnkey being the critical word there. But wait, if they're taking on the entire site as a turnkey construction manager, the report mentions they're actually going to subcontract most of that specific work out to other companies.
They are.
Aren't they sacrificing their profit margins? Why take on a billion-dollar project just to act as a middleman and hand the actual building over to someone else?
On paper, in the short term, you're correct. Taking a management fee while subcontractors do the heavy lifting yields lower profit margins.
However, they are generating a very high return on invested capital because they aren't tying up their own machinery and labor. The true long-term play here is a classic land and expand strategy. By securing the overall construction management contract, they get to control the entire massive site.
I see. It's like being the general contractor hired to build a sprawling luxury estate.
Exactly.
At first, you're hiring out the framing, the electrical, and the plumbing to outside companies and just taking a management fee to coordinate the chaos. But eventually, as you grow, you use your capital to buy up the plumbing company, the electrical company, and the framing company.
Yes.
Suddenly, you aren't just managing the project. You own the companies doing the actual labor, and you're capturing the value at every single stage of the build.
That is a brilliant way to visualize it.
Right.
Once MasTec is managing these massive data center sites, their goal is to increasingly begin to self-perform the civil engineering work, the power delivery, the specialized telecom routing, and the ongoing maintenance themselves.
Makes total sense.
They're getting their foot in the door at the absolute highest level of site management, so they can eventually feed the work down into their own specialized divisions.
And to execute that strategy, to effectively become the company that can self-perform all those specialized tasks, they are leaning heavily into a very specific merger and acquisition strategy. They aren't just waiting to grow these capabilities organically, they are going out and buying them.
They certainly have the capital to do it. The sources show they're sitting on about $2.1 billion in liquidity.
$2.1 billion.
Right. The financial officers also noted a net leverage ratio of just 1.7 times, meaning their debt levels are highly manageable compared to what they earn. They have a massive war chest to go shopping for other companies to complete that general contractor puzzle we just talked about.
That's huge.
In fact, they expect about $500 million in 2026 revenue just from recent acquisitions alone.
The specific acquisitions they discussed on the call are incredibly telling, too. They highlighted the purchase of a company called NV2A. This is a construction management firm that actually served as MasTec's joint venture partner on a massive $600 million expansion of the Miami airport.
Buying NV2A instantly deepens their high-level construction management expertise. Think about what an airport expansion requires.
It's massively complicated.
It's a live, high-security environment with incredibly complex logistics, heavy structural engineering, and integrated technology systems. If a team can manage a sprawling airport expansion, they possess the exact DNA required to manage the construction of a mission-critical AI data center.
But there was another acquisition mentioned that caught my eye even more. They bought a company called McKee Utility Contractors.
Yes.
This is a third-generation family business that specializes in water infrastructure. So you have to ask, why does a company that is aggressively pivoting into building high-tech AI data centers suddenly care so much about buying a local water infrastructure business?
If we connect this to the bigger picture, the link is absolutely vital. The processing power required for the AI boom, these massive server farms running complex learning models, it generates an astonishing amount of heat.
Right.
These data centers run incredibly hot, and to keep them from melting down, they demand massive amounts of water for their cooling systems.
It's funny, we treat the cloud like it's this magical, weightless thing floating in the sky above us. But in reality, it's a giant, sweating warehouse in Virginia that needs a literal fire hose of municipal water just to keep ChatGPT from overheating.
That is the exact physical reality. We are seeing municipalities all over the country being forced to entirely rethink and rebuild their local water infrastructure just to accommodate these new tech projects.
Because the existing pipes just can't handle it.
They really can't. A single massive data center can consume millions of gallons of water a day. Water is rapidly becoming the next critical bottleneck for the AI boom. By acquiring a water infrastructure company like McKee, MasTec is positioning itself to clear that exact bottleneck for their tech clients. They're looking 3, 5, even 10 years down the road at what these developers will desperately need.
It really shows how interconnected all these different segments of physical infrastructure are. And speaking of segments, let's break down how the rest of MasTec's business is functioning. In the call, it sounded like the company is essentially running like a 4-engine jet right now, and all 4 engines are surging simultaneously. Let's look at the first engine, their pipeline infrastructure segment.
The resurgence in the pipeline segment is remarkable. They posted 50% year-over-year revenue growth in the fourth quarter alone, maintaining an 18.5% profit margin.
50% growth is wild for physical pipelines.
It really is. Management even stated on the call that they believe this segment could hit or exceed its historical revenue peaks by 2027.
Then you have the second engine, power delivery. This segment grew by 13% in the fourth quarter. And what is really compelling here is the sheer scale of the projects they were taking on to modernize the grid. They highlighted a project called GreenLink on the call. What exactly does a project like that entail?
Projects like GreenLink are massive, high-voltage transmission lines designed to connect new, often remote renewable energy sources to the main power grid. They are logistical behemoths.
I can imagine.
GreenLink had actually been a stalled project held up by endless permitting and environmental review delays.
Yeah.
But MasTec just got the green light to clear those delays and restart the project earlier than anticipated. Coupled with the fact that this group just won its second largest transmission project ever, it shows that the demand to upgrade the national power grid to support all this new technology is just off the charts.
Which brings us to the third engine, communications. This is their legacy business, the teams laying fiber optics and building out telecom nodes. Yet even as the most mature part of the business, it still saw a massive 23% organic growth rate in the fourth quarter.
Very impressive for a mature segment.
It is. But I noticed something interesting in the transcript regarding this segment. They mentioned absorbing a lot of startup costs because they are opening new offices. Why are they opening so many new offices for a legacy business? Are they chasing specific regional federal grants?
That is a major part of it. The rollout of fiber optics to rural and underserved areas requires a massive, localized physical footprint. You can't just fly a crew in for a week and leave.
Right.
You need local equipment yards, local management, and local labor. Establishing that footprint requires opening new branches, buying new heavy equipment, and critically, training brand new crews from scratch.
Right. You can't just hand someone a hard hat and tell them to go lay high-capacity fiber lines. There are certifications, safety protocols, and complex machinery involved.
Exactly. And that flows right into the fourth engine, clean energy and infrastructure, or CE&I. This is where we see some of the most dramatic future indicators.
The numbers here were huge.
They were. Their backlog in this segment jumped 30% sequentially, just from the third quarter to the fourth quarter, reaching $6.5 billion. That encompasses massive wind, solar, and battery storage facilities, and it is where that massive shadow backlog of renewables we talked about earlier lies.
But of course, scaling 4 heavy industry engines at the exact same time is incredibly expensive. You can't just push a software update to double your physical workforce. I noticed their overall margins actually dipped slightly, going from 8.2% in 2024 down to 8.0% in 2025. Was that dip entirely due to the startup costs in the communications segment we just talked about?
The startup costs in telecom were a significant factor, but the friction of physical reality hit them in a few different ways. In the power delivery segment, for instance, they faced mixed headwinds because there was a noticeable lack of storm-related revenue in 2025.
Storm-related revenue? You mean like hurricane repair work?
Yes. When a massive storm knocks out power grids, utility companies rely on contractors like MasTec for emergency time and materials repair work.
Yeah.
It is highly lucrative, high-margin work.
That makes sense.
Ironically, when you have a milder storm season with fewer destructive events, utilities don't spend that emergency budget, which naturally softens the profit margins for that specific segment in that quarter.
That makes perfect sense. And I assume that new, highly touted turnkey data center work is also playing a role in the margins. Because they are subcontracting out the actual labor on that first big billion-dollar job, they are only taking that construction management fee we discussed.
That is the other major factor. It is lower margin work by definition. So even though it brings high returns on capital and positions them brilliantly to own the entire construction ecosystem in the future, it is mathematically going to drag down the margin percentages for the clean energy and infrastructure segment as we move into 2026.
So it's a bit of a reality check on the cost of hypergrowth. For all the excitement about 2026 and their guiding for a massive 19% revenue growth, the company is only projecting a very modest half percentage point expansion in their overall profit margins.
Right.
They are targeting just 8.5% for the year. It really highlights how incredibly expensive and logistically complex it is to deploy physical labor at this scale.
Navigating that friction while trying to meet unprecedented simultaneous demand across energy, water, tech, and communications is the central challenge for their executive team going forward.
So what does this all mean? For you, the listener, the biggest takeaway here is a fundamental shift in perspective. The next time you read a headline about a revolutionary new AI model or a massive new cloud software platform, I want you to picture the reality behind it.
It's not just code.
It's not. Picture the absolute army of workers laying thousands of miles of fiber optic cables. Picture the engineers erecting high-voltage transmission towers. Picture the local crews digging up streets to upgrade municipal water lines just to keep the servers from melting down. The digital future isn't floating in the cloud. It is being built into the dirt with literal concrete, copper, and steel.
Before we wrap up, I want to leave you with a scenario to think about based on the timeline we've been discussing. We know 2027 is the year that massive federal rural broadband projects, specifically the BEAD program, are slated to kick into high gear. It is also the year MasTec expects their pipeline construction to hit historical peaks.
Right at the exact moment, this privately funded AI data center boom is expected to reach a fever pitch. 2027 kept coming up in the transcript as this massive inflection point.
So ask yourself, what happens when unlimited tech venture capital collides with massive federal infrastructure grants, and they are both fighting over the exact same highly limited pool of copper wire, specialized excavators, and union electricians? How does the global market handle that kind of overlapping explosive demand when the supply of skilled physical labor has a hard ceiling?
That is a fascinating collision course to watch out for. The physical constraints of the real world might just dictate the ultimate pace of our digital advancement. Thank you so much for joining us on this deep dive into the physical foundations of the tech boom. We hope this gave you a whole new lens through which to view the infrastructure supercycle. Keep staying insanely curious, and we warmly invite you to bring your next stack of sources for us to explore together.